Imagine if every debt in the world had to be paid back. Every credit card, every mortgage, every corporate loan, every government bond. No rollovers, no refinancing, just paid in full. It sounds responsible, almost moral, and it would instantly collapse the global economy. That's the uncomfortable truth most people never hear. A huge portion of debt is not designed to disappear. It's designed to exist, to roll, to grow, to quietly hold the system together. And once you see why, it's hard to unsee it. Right now, global debt sits above $300 trillion. That's more than 3 times the value of everything the world produces in a year. If debt worked the way we're told it does, borrow, repay, finish, this number wouldn't make sense. Yet it keeps climbing, decade after decade, crisis after crisis. So the real question isn't, why is there so much debt? It's, why hasn't it blown everything up yet? To answer that, we need to change how we think about what debt actually is. Most people imagine debt as a personal failure or a temporary bridge. You borrow, you struggle a bit, you pay it off. End of story. But zoom out to the system level, and debt plays a very different role. Debt is not just money owed, it's a promise that creates money in the first place. When a bank issues a loan, it doesn't hand over existing cash from a vault. It creates new money digitally, backed by your promise to repay later. That means repayment doesn't just remove debt, it deletes money from the system. Which is fine, unless everyone does it at once. Because here's the catch, the system needs more money tomorrow than it has today. Populations grow, businesses expand, governments spend, markets demand liquidity. If all debt were paid down faster than new debt was created, money would vanish faster than the economy could function. This is why debt never really ends, it rotates. Take government debt. When a government bond matures, it's rarely paid off with spare cash. Instead, the government issues a new bond to pay the old one. Old debt disappears, new debt replaces it. Same system, different paperwork. From the outside, it looks reckless. From the inside, it's maintenance. Because if governments actually tried to eliminate their debt, they'd have to pull enormous amounts of money out of the economy through taxes or spending cuts. That doesn't just hurt growth, it triggers recessions, unemployment, and political chaos. So they don't. They roll the debt forward and call it stability. The same logic applies to corporations. A healthy company doesn't rush to eliminate all debt. It manages it, rolls it, uses it as leverage. As long as cash flows continue, the debt is doing its job. Even banks themselves depend on debt that never fully clears. Deposits are liabilities, loans are assets. The balance only works if obligations remain outstanding. Which brings us to the part no one likes to talk about: interest. When debt is created, only the principal is created, not the interest. That extra money has to come from somewhere else in the system, usually from new debt issued later. Which means, mathematically, if all borrowing stopped tomorrow, not everyone could repay what they owe. There literally wouldn't be enough money to do it. Someone would default, or many people would. Defaults aren't bugs, they're pressure valves. They release stress in a system that otherwise would implode under its own arithmetic. This is why crises tend to follow the same pattern: easy credit, rising leverage, confidence. Then something small breaks. Rates rise, cash tightens. Suddenly, rolling debt becomes harder. The music slows, and anyone who can't refinance in time gets crushed. It feels random. It isn't. It's what happens when a system built on continuous rollover briefly forgets how fragile that assumption is. And here's where the irony really sharpens. We're constantly told to be responsible with debt, pay it down, live within your means. And at the personal level, that makes sense. But at the system level, widespread debt elimination is treated like a threat. When households all try to save at once, economists call it a paradox. Growth slows, businesses cut back, governments panic, central banks intervene. They lower rates, they inject liquidity, they encourage borrowing again. Not because they love debt, but because the system can't breathe without it. This creates a strange psychological split. Debt is framed as a personal moral issue while being a systemic necessity. Individuals are blamed, institutions are supported, and most people never notice the contradiction until something breaks. When interest rates rise too fast, suddenly debt stops rolling smoothly, mortgages reset, governments feel pressure, companies that relied on cheap refinancing get exposed. What looked manageable becomes impossible. That's when people start asking questions. Why does it feel like the system only works when debt keeps growing? Why does paying things off feel like sabotage at scale? The answer is uncomfortable. Modern economies are built less like households and more like escalators. You don't stop them, you keep them moving. You just try not to trip. This doesn't mean debt is fake or that repayment doesn't matter. It means the goal was never zero. The goal was continuity. And continuity depends on trust. Trust that loans can be rolled. Trust that money will circulate. Trust that growth will outpace obligations just enough to keep everything balanced. When that trust weakens, everything suddenly feels fragile. Which brings us to now. Global debt is higher than ever. Interest rates have risen faster than at any point in decades, and refinancing, once assumed, is becoming uncertain in places that never worried before. That doesn't mean collapse is guaranteed, but it does mean the illusion is thinning. Because once you understand that most debt was never meant to disappear, you start seeing the system differently. You stop asking when it will be paid back and start asking what happens when it can't be rolled forward anymore. And that's the question no one has a clean answer to. What happens when a system built on permanent debt finally meets a limit it can't refinance its way out of?